It is 4 p.m. and welcome to this month's Macro Insights Livestream. I'm Eugene Liao, rate strategist for DBS Bank, and today I'm joined by senior economist Nathan Chow, who will be looking at the China and Hong Kong economy and taking us through the latest developments. So today's live stream, we're talking about two broad areas, right? One is calibrated Fed easing, and the second part would be on China's uneven recovery. So it's again broadly into three different sections. Next slide, please. So the first part, I'll be talking about why the Fed is embarking on easing. So we should be on slide 2, why the Fed should be embarking on easing and why it will be a calibrated one. After that, we'll be talking about China and the recovery path that it's taking. And the third part will be on Hong Kong and why there are pockets of resilience, even though there are some cyclical headwinds. So to kick things off, right? So on to the next slide. We are in a very interesting period where interest rates have been high for quite a while, right? This chart shows an extended period all the way back to pre-global financial crisis, where interest rates were considered very high. Then we go into a period where interest rates were very low because of QE, NERP, as well as ZERP. Interest rates were close to zero. The pandemic, where the interest rates reached an all-time low. And the post-pandemic era, where defying all the odds and all the shocks that have hit the global economy, if you look at the 10-year yields for both the US as well as across the DM space, yields have stayed very, very buoyant. Right, so there have been a lot of talks about recession and shocks, etc., but they have not quite managed to derail the global economy nor bring interest rates low. So, inflection point, are we getting there? Now, that would be a very important question to ask. Now, on to the next slide. Now, why are interest rates so buoyant? Right, so if we move on to slide number 4, you realize that there are good reasons why interest rates are buoyant, and that one of it is because the global economy has been much more resilient than what many people, including ourselves, have expected. Now, if you went from a period of close to zero interest rates to the Fed hiking to 5.5% in a very short span of time, and then without anything seriously breaking in the global economy, that is speaking of a lot of resilience. So we show that in terms of composite PMIs, right? So we have split them into the emerging markets, the developed markets, as well as the world. So what you notice is that over the past 4 quarters or so, despite all the worries about the slowdown, high interest rates, stresses on housing market, by and large, things are getting better, right? So as long as the fundamental backdrop is one of recovery, then it makes sense that interest rates should be somewhat more supported than what we are used to. And that's the reason why, even though we have been seeing a bit of easing across the world, it's not a flat out crisis kind of easing. It is really more of calibration. So against this supportive backdrop, we should also nuance between the emerging markets as well as the developed markets. So we take the difference in the composite PMIs, and what you notice is that the emerging markets are actually doing quite okay. In fact, in relative terms, they're doing better than the DM. So again, whether you look at the global economy as a whole or you split it between EM and DM, it seems to be reasonably benign, and it's actually much better than what many people would have expected, say 3, 6, 9, 12 months ago. So what should we expect going forward? So looking at the next slide, things have been good for some time, right? And the Fed has held rates steady for close to a year. And how do we view the framework or the case for easing or tightening, right? So we fall back to the Taylor rule, right? So for the Fed, there's a dual mandate. They're looking at both employment, the full employment, which could be anywhere between 4.5%, for example, as well as stable prices around 2% inflation. And if we do a Taylor-Rule model around it, what you notice is that the model output has now dropped below the Fed funds rate actual. So the gray line is now below the red line. So which means that for the first time in this cycle, at least over the last few data points, it's saying that policy settings might be a little bit too restrictive, right? So the Fed need not follow this kind of prescriptions very closely, and there are leads and lags, and there are cases where policy space might be a lot more constrained. So, for example, post GFC, right, the US financial system and households took a very long time to recover. And what it is prescribing at that point would be negative interest rates, right, which is really difficult to do. And then therefore, it makes more sense to run QE in place of negative interest rates to further stimulate the economy. Now, the same can be said when we pull closer to our current cycle, where the Fed was a little bit slow when confronted with rising inflation. Right, so it kept things a little bit too loose and interest rates a little bit too low for too long. But after that, to Powell's credit, the rate hikes came, and they came very aggressively. And over time, the policy settings converge to where the Fed funds rate is, and that makes for a neutral kind of backdrop where things are just nice. So we are now tilting to the point where there's some weakness seen in the labor market, right, that is tilting towards some kind of easing, as well as we should be considering that inflation might be a lot less of a problem now compared to, say, 2 years ago. Right, so I think there is a shift, right, in terms of how the Fed places its weight on employment as well as inflation. So things are shifting. Previously, a lot of worries on inflation, very little on economy and employment. Now I think it's going to get a bit more balanced, and there's a little bit more worries on how the labor market is holding up. Next slide, please. So as we move on to the labor market, there are many, many ways to gauge it. And I think one of the more frustrating elements about it is that across a wider swath of labor market data, you will see that things are weakening. And until very recently, non-farm payrolls generally has been holding up very, very well. So I think it is better to consider a wide range of data. And the chart on the left, I show you the broadest measure, the unemployment rate. It has been on an uptrend for a few quarters. At the low point, it was about 3.4%. And at the latest data print, it was 4.1%. Now, 4.1% is important, right? Because the Fed put in its SCP forecast in June that the forecast by the end of the year should be around 4. So we have exceeded this level, right? So does it mean something has changed? Or does it mean something for policy? Right. So if you want to look at the broader range of data across, so we can look at the number of unemployed persons, we can look at job openings, and we can condense it into one single indicator, which is the number of jobs per employed person. And that figure has fallen from a peak of about 2 to currently about 1.2, right? So 1.2 is a level that is last seen pre-pandemic. So pre-pandemic, so this kind of levels are a lot more balanced. And if you just look at the trend, rising unemployment rate, as well as less jobs per person and less job openings, the clear trend is that the labor market is softening, right? But it is not quite falling off a cliff, which is a good thing, right? So this kind of softness will filter into the decision making for the Fed, and I think it will shape how the Fed reacts in July as well as September, December, and assuming that the CPI print comes in relatively in line and shows that it too is softening, then we think that the stage is set for 2 cuts this year, one in September and one in December. So moving on to the next slide, right? So we know that the Fed has set some guideposts or guidelines as to where when it would cut rates. And SCP are one of the drivers of employment, right? If the unemployment rate goes up beyond a certain level, then on more cuts than what is penciled in the dot plot in June, which is 1. So we think that hurdle is probably can be cleared given where data stands now. And if the Fed is going to cut rates, then we should be bracing for slightly steeper curves. The chart over there shows you the 2-year, 10-year segment of the curve. And what you notice is that the curve will see periods where there is tremendous steepening, right? This typically takes place when there is a crisis and the Fed is forced to cut very aggressively, bringing 2-year rates down a lot more than 10-year rates. Now, there are also periods where the long end went up a lot. So, for example, the taper tantrums, and then that could happen if there are fiscal worries or term premium worries that could kick in. Now, if you move on to the current cycle, right, there's been a bit more of stagflation worries, right? Because we have a very aggressive hike cycle, and there's just been a lot of pessimism as to whether the economy can hold up. So therefore, the curve has been inverted for a very, very long time. Now, what are the drivers for the curve, right? Over the short term, meaning the next few months, as well as beyond the next few months. So I think in terms of the short term, the US elections might be quite important to watch, right? So in general, if the odds of Trump coming back in as president is higher, then we should see a steeper curve, right? Generally, there will be more worries on the fiscal front, more worries on tariffs, and there might be more political risk premium being embedded. Now, if it is not Trump, right, the risk are not Trump, but it's Biden or an alternative candidate, we should see slightly flatter curves, right? So this will be the micro movements that we should expect as the US election heats up. Now, moving on to the broader, larger driver, right, which would be the US economy. So it will be a call of whether there will be large market stresses that will hit, right, at some point, or the data suddenly falls off a cliff. Then, in which case, the Fed either has to step in to try and stabilize the markets or try to arrest the decline in data, and that will result in aggressive Fed cuts. Now, if that's not going to happen, and which is also not our base case, we think that it would be a managed slowdown, then calibrated easing would be more likely. So in which case there will be steepening, but probably not at a very rapid pace that we saw in the previous cycles. Right. So moving on to the next slide. So we're looking at the breakdown of dollar rates. So it was very violent in the early part in 2022, 2023, when the fight was very aggressive and the market was very unsure as to how the economy and how the different asset class would react. Right? But if you go towards the end of last year into this year, what you notice is that the gyrations become much smaller because the Fed has been on hold for some time. Yes, there's some speculation on either end, right? That whether the Fed should be cutting earlier or later. But by and large, we have been in the Goldilocks conditions. So our core view hasn't changed, right? So calibrated cuts this year, 2 this year, followed by 4 in 2025. So in terms of market pricing, it's gravitated very closely to where we are penciling the forecast. The term premium may be a little bit too low, but this might be subject to swings as the US election heats up. So again, the big driver, aside from the Fed and economy, would be the US presidential elections. So as we zoom broader out, we've talked much about the US, but what about the rest of the world? So we have the policy rates across the G10, and what you see is that there's been some consistency, right? So generally, tightening into a period of pause. And then more recently, there are a few central banks that have started easing, right? The ECB, the Riksbank, and then the SMB, and then BOC as well. So they have started easing because conditions have aligned, right? Either weaker labor markets, lower inflation. So there's no longer a need to keep policy settings that restrictive anymore. So we should look at this and say that, okay, we have gravitated from a period of high rates shifting towards easing as a block. The Fed, the UK will likely follow suit. There will be some laggards. So in this case, the most obvious one would be Japan. So Japan has been slow in normalizing policy because it has other concerns. But with the yen weakness and the rising wages, there's increasing pressure for the BOJ to do more. So whether this comes in terms of reduced bond buying or increase in interest rates, which will probably be very calibrated, we think that that is the trend that's likely to stay. So there'll be a bit of divergence over there. So the other one where they might be interesting would be Australia, because the RBA is facing slightly stickier inflation. And the RBA also has not been as aggressive as much of its G10 counterparts. So in which case, there could be room for further tightening if needed, or they could hold rates longer than many of the other central banks within their space. So easing has begun, but it looks like it's going to be calibrated, and there are a couple of outliers there. So moving on to the next slide. So Japan, I was stating that they really are quite different from the rest of the world. And we have this radar chart on the left, which shows you the break-evens across 6 different markets in the DM space. So anything that is close to the middle, so the red line shows you where we are now, then the gray line shows you where we were 9 months ago. So what you notice is that the red line is actually on the outermost side for Japan. Now it's the only one we're showing that. Right. So what this tells us is that if the central bank is not as aggressive in trying to curb inflation, then there will be less confidence that inflation will be under control. And then the best way to hedge out this kind of risk or express this view would be to bring break-evens higher. So for many parts of the rest of the DM space, break-evens are low because inflation is viewed to be largely contained after aggressive Fed hikes. So again, Japan stands out. So if you break down the movements in the JGB yields, what you will see is that inflation expectations has been one big driver of why the longer end has been rising. Policy expectation changes. Yes, it is small, but the BOJ tends to move in very, very small increments. So the brunt of the shift in perception on tightening is really more so in the long end, unless the BOJ decides to speed up tightening in the front, meaning rate hike more aggressively. Then the curve will likely stay steep for a little while longer before flattening out. So moving on to the next slide, the current environment for Asia, it's kind of mixed, right? We can plot them on two axes, FX performance versus the dollar, as well as the change in 10-year local currency yields. So there are a few things that would be supportive for govies in the region, right? One of them is if US yields fell, that would help a lot, right? So US yields did fall, and that has allowed some of the markets which have been facing a little bit more pressure. So some of these pressures have been eased somewhat. But for some of the markets which have not hiked as much, for example, in Thailand, Malaysia, then the yields did not fall as much, right? Which makes sense. The standout again is Japan, right, which is facing both currency weakness as well as yields that are rising, despite the fact that the US yields in the more recent couple of months have been falling. So I think what we see over here is that there's no clear-cut point where EM or Asia local currency bonds will perform very well, because you require two conditions. One is that US should fall fairly significantly, and then the second point is that the dollar has to be clearly weak. Right, we might get there if the Fed starts to signal that rate cuts are coming, but over the past 2 years or so, it hasn't been a clear-cut narrative that these local govies should do particularly well. Right. So the takeaways from my end is that generally we are pivoting towards easing, and some of this has been shown in some of the yen central banks already. We should expect calibrated easing because we doesn't look like we're going to hit into a big crisis. And the third point is the BOJ stands out as an exception, and it's facing considerable pressure to normalize policy. And in terms of the curve, aside from fundamentals and the Fed, we should also consider the US elections. So I'm going to stop at this point. If you could move on to the next slide. And one more. Yeah, so these are the takeaways. And then for the next slide, if you all have any questions on the, please scan the QR code. And then we'll be happy to address them towards the end of the webinar. So right now we'll have Nathan take us through China and Hong Kong. Next slide, please.
All right, thank you very much, Eugene. So for the China's economy, the economic recovery over there so far is a bit uneven. I would say it's like a patchy recovery, with the supply side doing better than the demand side. Okay, for instance, industrial production, manufacturing have been relatively strong because external demand is quite robust, largely due to the recovery of the electronic cycle. People around the world are buying electronics again, right? And we have actually visited some of our TMT clients over the past couple of months. They are doing quite good. And Chinese exporters are outperforming also due to the fact that they are diversifying their customer bases, selling more stuff to other countries in Asia, especially ASEAN countries, right? And at the same time, trade with Russia is also rising encouragingly. So if we look at some leading indicators like Caixin PMI, it suggests that the manufacturing momentum will sustain in the near term, especially with the Christmas order season coming up. So I would say the supply side is going to lead the recovery in the near term. And on the contrary, domestic demand, such as consumption, is still sort of lagging behind the recovery. All right, as you can see on the chart on the right, it is not bouncing back as fast as market expected because people are not getting jobs back as quickly as expected. It's been, for instance, it's been very tough for teenagers or fresh graduates to get a job. Even in the big cities like Shanghai or Beijing, companies were offering less dough right now. Some of them are cutting wages, and some of them are cutting perks like travel and meal allowances. So against this backdrop, relatively speaking, services consumption like catering, restaurant, hotel, they are doing better than good consumption. So that's why luxury brand sales have been quite sluggish overall, okay, over the past few 6 to 12 months. And because of a lack of confidence, people are sort of now sitting on a lot of money in their savings accounts, right? But of course, the flip side is that once people start seeing their paychecks getting bigger and they feel more financial secure, they're going to start spending that money again. That is for sure. But for the time being, we are not there yet. We just need to be a bit more patient, okay? And in terms of property investment, which is still sort of tepid, as you can see, the black line on the right chart, it is still a big drag to fixed asset investment. But there are two things the Chinese government doing that, I think, will stabilize the market gradually. One of them is that they are urging developers to, finish building their housing projects. So this is why we are seeing more homes being completed in the past 3 to 6 months. And at the same time, the government is also rolling out policies to reduce home inventory so that developers will be able to get more money and avoid going broke, right? So this will make people more confident in the housing market and encourage them to buy more homes, okay? And because of these new policies, property sales are having a bit of a pickup in June and in early July. But of course, we got to keep in mind that there is always a seasonal uptick in June, meaning we will have to watch the data over the next few months to see if the latest recovery has legs or if it was just driven by seasonal factors, window dressing factors. Okay, so that's why I just said that exports will very likely continue to lead the recovery in the near term. And next slide, please. As far as trade tension is concerned, the new EU tariffs on Chinese electric vehicles are definitely a negative development on the trade front, right? Some specific Chinese firms exporting EVs could take a big hit from the steep extra as much as 38% tariff rate, right? But the overall macroeconomic impact is going to be manageable. So last year, China's EV exports to the EU were about like 10 billion euro. That is about like 0.5 of China's total exports, right? So it's not that much. And there is also a chance that the final tariff could be lower than proposed, because right now the automakers from Europe, like Mercedes, they have already rejected the tariff plan, right, fearing retaliation from China. So my take is that there will be a lot of negotiation going on from now to November, and as far as I understand, that the Chinese car makers are so flexible and efficient, and they are always ahead of the curve. So I would say the end result is that we'll be seeing more and more car makers from China to speed up building more factories in Europe, like what BYD is doing. They are building factories in Hungary, they're building factories in Poland, right? So they're gonna find a solution for this. With Europe, it's not gonna be a very, very big deal. With the US, it's a different story, okay? Moving on to the next slide. The big third plenary session is happening next week in Beijing. So these meetings are a big deal in China historically. Back in 1978, Deng Xiaoping kicked off major economic reforms under this framework, right? And in 2013, President Xi Jinping also announced reforms, for instance, to the one-child policy, reforms on the household registration system, the hukou system, right? So these meetings tend to signal important changes ahead. So this time around, the focus will very likely to be on boosting China's domestic tech capabilities, especially in key areas like semiconductors, high-tech things, okay? And so that's why policymakers will very likely to emphasize again the new quality productive forces. The goal is to rely less on foreign tech and reduce vulnerability to US trade restrictions. And on top of that, tax reform also looks to be on the agenda. Okay, so some reform measures may be announced to let local governments to keep more tax revenue, for instance. And the reason of doing that is, right now, local government in China are sort of getting squeezed from the housing slump. So the reform would give them more stable income sources. So for instance, right now, local government in China, they get half of value-added tax revenue and about like 40% of personal income tax. And the central government gets most of the corporate income tax and all of the consumption tax, right? So one of the possibilities is that they'll give local government a larger share of value-added tax and income tax. So the main message here is that this key meeting could unveil meaningful reforms. It will provide important clues into the next phase of development of China. So it should be interesting to watch. All right. And at a meeting, I believe policymakers will very likely reaffirm that policy, in terms of monetary policy, will stay supportive to help the recovery. So next slide, please. We are expecting the Central Bank of China, the PBOC, to cut the LPR in the third quarter. The ECB already cut, right? Just like what Eugene has mentioned. So the PBOC is not the first major bank to do so. So that would take some pressure off the RMB, right? And speaking of reducing RMB depreciation pressure, the PBOC has recently started using central government bonds as a policy tool. They're going to sell some long-term bonds to prevent yields from falling further. They are doing this also because they want to avoid a repeat of the SVB case. So what happened in SVB, what happened to SVB is that it took big losses on long-term government bonds when interest rates started to surge, right? So better to get ahead of that risk in China. So getting back to the question of cutting interest rate, the PBOC still has room to cut more, given the current disinflation pressure. Next slide, please. So we can see the chart on the left here. CPI inflation is just as low as 0.6% right now in China. So, and I believe it will remain very, very benign as long as the property market remains weak, right? And the chart on the right also shows us that right now the gap between M1 and M2 keeps widening, and especially the sharp slowdown in M1 means corporates have no plan for capital expenditure and household has no plan for big ticket purchases. So that is no good, right? So against this backdrop, in short, upcoming policy support looks very, very likely. There will be more rate cuts as soon as in the third quarter, and there will be more bonds to stabilize yields, and they're going to keep credit loose to prop up growth. And the slowing recovery that we are seeing right now is giving the PBOC more space to stay, accommodative. All right, so that's pretty much it for the China section. But before we move on to Hong Kong, just a friendly reminder to go ahead and drop any questions you've got into the pigeonhole. Let's show the QR code again, please, on next slide. Yeah, so that we can make sure we cover everything you want to know about before wrapping up. All right, so next slide, let's go to the Hong Kong section. So regarding the Hong Kong's economy, we have been hearing a lot of mixed news, some of it positive, some of it not so much. So we'll delve into them as much as we can in the next 15 to 20 minutes. But one thing that we would like to emphasize is that for sure, Hong Kong is still a very heavy weight when it comes to competitiveness because of its unique status, because of its geographical proximity to the mainland. It has been and it will continue to be the prime spot for money moving in and out of China. For instance, last year, 80% of foreign funds into the province of Guangdong flowed through Hong Kong first, and about 60% of Chinese outbound investment were routed through Hong Kong, right? So that is a very big business. So this is number one. Number two, as long as China aims to internationalize the RMB, Hong Kong will remain the top offshore RMB hub, right? Handling different kind of transactions. And number three, the wealth management sector in Hong Kong is also thriving, especially for high net worth families from the mainland China. So it is true that the city has some healing to do from what happened in the past few years, but we strongly believe that it will continue to excel in its key areas that we just have mentioned. Both the government and businesses are working on it seriously. Okay, so we can go to those points later, but right now, let's take a look at the current state of the economy from a cyclical perspective. Next slide, please. So similar to China, exports in Hong Kong is currently the main growth driver. They're starting to grow again in the first half of this year after some period of contraction in 2023. Okay, it has a lot to do with the recovery of the electronic cycle in the region. People around the world, just like what I just mentioned, they are buying a lot of electronics again. So that is good for Hong Kong because 70% of Hong Kong's exports are electronics related, right? And this trend is very, very likely to sustain. If we look at China's export numbers, if we look at the PMI numbers for exporters, if we look at the neighboring countries such as South Korea, which is a bellwether for regional trade, and they're doing good. They're doing good, and Christmas order season is around the corner. So the trend is going to sustain. That is almost for sure, and this actually explains why trade finance is rebounding. Next slide, please. All right. So as you can see on the right chart here, trade finance is rebounding. It's the year-on-year contraction is narrowing, even as other areas are seeing more negative numbers. Okay, so in general, the widening spread between onshore and offshore interest rate also constrains domestic loan demand. More companies chose to borrow from the cheaper mainland market, but at the end of the day, weak fundamentals explain most of the soft overall loan demand other than the export sector. Okay, and one of the factors facing a big headwinds is the retail sector. Next slide, please. So right now, domestic consumption is still under pressure. Especially tourist arrival is sort of, below the pre-COVID level. Tourist arrival, tourist spending, all of them are still below pre-COVID level, especially Chinese tourists, right? So what's happening right now is that there is a change in spending behavior. There's a change in spending pattern. So what most Chinese tourists right now they're doing is that they take cues from social media for what is trendy, right? For instance, which restaurants get a nicer cheesecake or which cafe get a nicer view, right? So they are more into casual stuff right now instead of luxury purchases like bags or watches, right? So against this backdrop, in aggregate terms, they are spending less. Okay, they are spending less. So this is number one. Number two, during the pandemic, most of the Chinese online stores, they have started selling a lot of Hong Kong products, Hong Kong goods, like milk powder, right? So that got a lot of people, they used to shopping online so that they don't have to come physically to Hong Kong, okay? Not as much as they used to before COVID. Okay, so this is number two. Number three, right now during major holiday, more Chinese shoppers, they're going to other places like Japan. The yen is very weak. The yen is very weak, right? And even within China, more and more Chinese shoppers, they go to Hainan instead of Hong Kong because of better deals, because of no taxes over there, right? So against this backdrop, luxury retail is the obvious loser, as we can see on the right chart here. Luxury, their sales are, still 40% less than the level in 2018. Okay, and relatively speaking, supermarket is in a better shape, but they're also sort of feeling the pressure. They're also feeling the pinch because right now, as we can see on the next slide, more and more Hong Kong people are, they're going to Shenzhen for cheaper goods. Okay, so as you can see on the left chart here, daily average Hong Kong resident departure from Hong Kong to the mainland China, especially Shenzhen and Zhuhai, has already surpassed the level before COVID. Okay, so that's why, because of this background, retail rent in Hong Kong right now is under pressure. Okay, it sort of resumed its downtrend after a brief rebound last year, and since the peak we've seen in 2019, it has fallen by more than 13%. Okay. Moving on to next slide. On top of domestic consumption, property is also under pressure. Okay, it's still under pressure. After those property controls got scrapped in February, home prices went up a little bit in March and April, but then it dropped again in May and June. In terms of primary sales, in terms of secondary sales, both of them dropped quite a lot in June, even though developers are slashing prices. So one of the major developers in Hong Kong, they have just started selling a new project, but at the lowest price in 8 years. So one of the challenges facing the Hong Kong's property market is that there is a massive inventory. So that's why every developer is offering discounts, trying to clear out their stocks. So massive inventory is one of the obstacles. Another headwind is negative carry. Because the Fed has been delaying interest rate cuts, the capital cost for banks is very high, buyer confidence has taken a hit. So that's why many people are still taking a wait and see mode due to the fact that the mortgage rate are still way higher than rental yield, as we can see on the right chart on this slide, right? But it's not all gloom and doom. One of the good things is that residential rental rates have been going up over the past few months, and right now they're at the highest since 2020. That means the demand is still very solid. Okay, and next slide, please. One of the big reasons for this solid rental demand is the Talent Pass program that has launched in 2022 to get skilled professionals around the world, especially from China. It has boosted the working population significantly. It has boosted the high income earners significantly. And given the fact that the summer season is coming, we do expect that rents will keep rising. Okay, so right now we've got a situation where property prices are going down, but rents are going up, meaning rental returns is increasing, right? So that ultimately could get renters to buy. Okay, so that is a good thing. So let's say, for instance, when we see a rental return larger than 3.5%, for instance, right, that should attract more investors to purchase homes and support prices in some extent. Okay, and next slide, please. Another positive is that the mainland investors are also more interested right now because of the removal of the stamp duty by the government for foreign buyers. So that is a very positive policy development. And with home inventory set to fall around 2026, that should boost Hong Kong home prices in the medium term, support the residential market in the medium term. All right. So moving on to the next slide, we take a look of the stock market. Hang Seng Index has regained some mojo in recent months. The average daily turnover recovered to the previous peak. So I would say that is a good news to the IPO market because the IPO market in Hong Kong has faced quite a lot of challenges in the past few years, such as high U.S. interest rates, regulatory scrutiny, slower economic growth, and the U.S.-China tensions. So all of these factors have constrained the IPO activities in the city, right? But the thing is that more or less, I would say the stock market performance has already factored in these uncertainties, all right? And some of these macro trends are now starting to turn around. So that's why we are seeing more US dollar funds moving back to Hong Kong. And if we look at the data, the aftermarket performance of IPO in Hong Kong has been improving. In the first half of this year, the average first day return is it's more than 20% first day return, okay, way higher than last year. So this positive momentum will encourage for potential IPOs activities, okay? And on the policy front, the Chinese regulators have also recently rolled out a new version of National 9 rules promoting venture capital and support IPOs. So that's why we are seeing more and more companies that were previously waiting for listing in the Asia market. They have decided to switch to Hong Kong. So right now, the approval process, thanks to the new rules, is now a lot quicker. Everything has become a lot smoother. All right. So looking forward, the interest rate environment will also help. So let's say if the Fed cut interest rate by 1% in the next 12 months, okay, let's say that's going to happen, then that would have a significant effect on the IPO market. So we're going to understand what happened over the past 1 year is that everybody loved US Treasury bonds so much. The yields were so high, right? But going forward, the lower interest rate will make IPOs more attractive compared to other investment options. So like what I said at the very beginning, Hong Kong is still a heavyweight when it comes to competitiveness, especially given its strong financial services ecosystem. Okay, so that's why wealth management business will continue to be one of the bright spots in Hong Kong. Next slide, please. So the fact is that there is a large and growing market of high net worth individuals in China, especially in the province of Guangdong. A lot of people are seeking investment options, right? There are over 300,000 wealthy families over there in Guangdong. All of them need investment vehicles, right? And about 50% of them are concentrated in Shenzhen and Guangzhou, right? And more and more of them participate in the Wealth Connect scheme between Hong Kong and the mainland that provide access to offshore wealth management products in Hong Kong. So we should expect increasing engagement in Wealth Connect for several reasons. One of them is that the investment quota has been increased recently, and the list of eligible products has also been expanded recently, and the investment threshold has also been lowered. Okay, so that's why we should expect all of this related business to grow in the future, in the near term, right? So the fact is that for Chinese high net worth individuals, Hong Kong will remain a highly attractive overseas location to them, so that they can invest their capital because of different needs for diversification, access to foreign assets, for currency stability, or even education overseas, immigration, a lot of reasons to put money in Hong Kong. So that is why, as you can see on the table on this slide here, Hong Kong is expected to be the #1 booking center in 2027, taking over Switzerland. All right, so that's it for the Hong Kong section. let's go to the Q&A section, shall we?
All right, thank you very much, Nathan. So we found out quite a bit more on China and Hong Kong, and let's bring up the pigeonhole questions. So what I can see over here is there's quite a lot of questions on China, Hong Kong, and a little bit on the US. So since there's a lot more interest in China, I'm gonna group some of them together. Right. So the first one would be with very high China macro data, very weak China macro data, disinflation, weak demand, high interest, real interest rates. How is the banking business going to be over the coming year? And I'm going to combine that with another question, which is on Hong Kong interest rates and Hong Kong banks. So these two. So perhaps Nathan, you would like to give a crack at these two questions together.
Okay, sure. Thank you, Eugene. And yes, most of the big banks, big Chinese banks, they took a hit last year. Their net interest margins, is dropping, and they also saw decreases in both net profits and total revenue. Not great. So going forward, it's gonna stay tricky out there for them. I would say the environment's only getting more complex. So what I understand is that they're trying to expand what they do against this backdrop. Like some of them are doing more car loans because home mortgages are not as hot as before, right? But that means there will be more competition for the auto financing companies. So it's kind of a mixed bag from macro perspective. Okay, and strategy-wise, some of the commercial banks onshore, they're looking to line up with the real economy's needs. That means things like tech finance, green finance, pension finance, and digital finance. That is the same direction the whole country is heading to, right? So that is also the direction of most of the commercial banks onshore. Okay, so the goal is to roll with the changes happening, and transform to keep growing in a sustainable way over the longer term, right? So yeah, they're gonna embrace change and evolve to stay strong in these tricky times. As far as Hong Kong is concerned, so recently, we have seen the interbank market rate, the 1-month and 3-month HIBORs coming down because of the seasonal half-year demand surge sort of winding down, all right? And at the same time, the expected Fed interest rate cuts are also putting downward pressure on the Hong Kong dollar swap curve. But here is the thing, because Hong Kong's aggregate balance, the liquidity situation in the interbank market is already very tight. So that means interest rate will probably decline only very gradually, like what we saw in the previous cutting cycle. So the way that I see it is that major Hong Kong banks will likely trim their prime rate very modestly by about like 12.5 basis points in the fourth quarter of this year. So in terms of NIM, because banks here in Hong Kong already saw quarter-on-quarter drops in net interest margins in the first quarter of this year, meaning major banks have already seen their peaks in the second half of last year. So we expect further modest downward pressure on margins over the second half of 2024 and into 2025.
All right. So the other interesting question is really on what role can Hong Kong play in facilitating the increased use of renminbi between China and the Middle East. So I think this question is quite a lot of different perspectives, whether it is petroleum or just increasing the use of renminbi, not just with the Middle East, but across the rest of the world. So maybe just take us through some of your thoughts on this issue.
Well, I would say Hong Kong can totally play a very, very important role in facilitating more RMB trade between China and countries in the Middle East. That is for sure. Uh, and the fact is that China and the Middle East has recently signed a deal to settle more trade in RMB. So it makes perfect sense given China is right now the top oil importer around the world, right? So after they get the RMB from the Chinese corporations, the Middle East countries can, I would imagine they can use those RMB for at least a few things. For instance, they can do more M&A onshore, buying up some of the mainland companies, and also they can also use the RMB to invest in infrastructure, right? Because what's happening right now is that uh, places like Saudi Arabia, uh, they're bringing in more and more Chinese firms like CTE, Huawei, and China Rail to build 5G, to build high-speed rail. So right now, after they get the RMB, they can pay for all that in RMB. So this is definitely good news for Hong Kong, because Hong Kong is already the main offshore RMB hub, settling the majority of global CNH transactions, right? And also, Hong Kong's capital market is also prepping for more RMB IPOs by adding the dual counters, the RMB Hong Kong dollar dual counters, to the Stock Connect programs. So that could totally help attract more Middle Eastern companies to list in Hong Kong using RMB. So that is how I see Hong Kong to benefit big time from growing RMB use between China and the Middle East.
Okay, so I'm going to have one more question on the PBOC. It's highly voted as well. So I think it's got to do with the repo and reverse repo operations, right? It's got to do with how PBOC conducts monetary policy. Do you have any views on this?
Oh, so what the PBOC is going to do is that they will use, according to their statement, okay, they will use repo and also reverse repo operations to add or remove money, liquidity, whenever they want to. So going forward, the rate will be set 20 basis points below or 50 basis points above the 7-day reverse repo rate. Uh, I would say it is a positive development, positive in a sense that sometimes we see huge volatility in the interbank market, especially towards quarter end, tax seasons, and long holiday, right? So the new and the tighter interest rate corridor will smooth funding costs and avoid excessive volatility. That is a good thing. Uh, and what I mean is that, in other words, they are sort of grabbing more control over the short-term rate. But don't forget, at the same time, they are also trading bonds to steer longer-term yields, right? So basically, what they are doing is that they are sort of controlling the yield curve. Okay, they want that upward slope to make sure banks are making money. They're profitable, and they want to make sure the whole system is stable. Okay, this is one of the policy goals. Another implication is that going forward, we should expect rate cuts will probably happen through the tweaks to the 7-day reverse repo. That can change anytime, any day. Okay, so that is different from the existing predictable monthly MLF rate changes. Okay, so the result is that it will be a bit harder for markets to position for rate cuts compared to the existing scheduled MLF changes. But the good thing is that the new change will allow the PBOC time easing more flexibly going forward. Let's say, for instance, around the Fed meeting, around the Fed, FOMC meeting, and et cetera, policy can be more nimble.
Okay, thank you very much. We've basically run out of time, so I'm just going to wrap things up on some of the questions that I've seen on the US. So I think the point here, whether the Fed is going to move or not, and whether the recession is coming, we're looking at a calibrated slowdown, calibrated cut. So we are really straddling the middle ground. And we do think that there are risks to holding rates high for too long. So that's why we think an inflection point is coming. Now, as to fiscal deficits, elections, and dollar strength and weakness, those may play out over a longer period of time. So there's a trading time horizon as well as a fundamentals horizon. So it's not that easy to answer that question in a very short span. So it is 5 p.m. Thank you very much for joining us in this session. So we look to seeing you next month. Thank you.
Thanks.